Good evening, everyone. Today we're going to be talking about candlesticks, understanding the Japanese candlesticks. This is the first part of the class because it's a beginner class. So we're going to be going through the first part of the class on this during the course of this session, right? So that we'll start to understand candlestick patterns. So candlesticks basically are very popular, right? So if you've ever looked into the markets, looked into the financial markets, or looked into a chart, you would have seen candlesticks. You may not have known what they are, but you would have seen them somewhere. Just like a picture, just like the kind of picture you're seeing on my screen right now. You'd have seen it somewhere in the news or somewhere, right? They are very popular, they are very widely used, and you're going to understand soon why that is so. So they were invented by rice merchants a long time ago. Now, rice merchants are rice traders, are commodity traders, right? There are many different types of commodities. There are metal commodities where you talk about gold, palladium, platinum, silver, and so on and so forth. Those are metal traders. Now there are energy traders. Energy traders are those that trade crude oil, Brent crude, WTI, natural gas. Those are energy traders. Then you have agricultural product traders, right? So these rice merchants were basically commodity traders, but they were focused on agri products, right? So the rice merchants, they developed it a very long time ago, but around the 1990s, Western traders began to, really take note of them. Western traders mean traders from the West, the United States, the UK, and so on. Traders from all this, from the West began to really pay attention, to these candlestick patterns because there were some unique features that they had that made it easier for them to use, easier for traders to use for analysis. Because the number one thing every trader is thinking is, how can I understand the market? How can I analyze the market so I can know where to enter my trades and when to exit my trades and make a profit? That's what every trader is thinking about, right? And they began to see that these candlestick charts are actually very useful in helping them achieve these things, right? So they began to look at them. Then Japanese candlesticks are a type of price charts, these are the things they show, right? They show the opening, they show the closing, they show the high and low price per time, a particular period, right? And when we talk about particular period, that period ranges from 1 minute all the way to 1 month. So if you're on a 1 hour chart, for example, all the candlesticks you have on your chart would be formed in the space of 1 hour. Each candlestick will be formed within the space of 1 hour, right? Now, if you go to a 4 hour chart, the same thing happens. Every candlestick you see is formed within a space of 4 hours, right? So you will see the open, high, low, close for the period for every candlestick, right? So when traders started using these, they were doing the daily, where they looked at the open, high, low, close for the market for a whole day. Then they used it to determine what will happen next tomorrow. And then they looked at it for a period of time, and it begins to give them a pattern that they can make profit with in the market. But of course, today we have technology, we have charts that are now, as small as 1 minute, and then we can really analyze the market in real time. Then they couldn't analyze the market in real time, right? So we have a lot of advantages today. So Japanese candlesticks today are very popular for price action analysis, basically for technical traders. Technical traders across the world right now use candlestick patterns. In fact, I haven't seen someone in a very long time who used anything other than candlesticks. Even versions of candlestick like the Renko chart is also like candlesticks, right? So there are people who may not use the this kind of candlestick and they use a Renko chart. The Renko chart is also a type of candlestick, right? And there are traders that use that. But basically, there are some features that make this candlestick very appealing. And the most important thing is that they are visual representation. How they appear visually is the reason why traders want to use them. When you see a green color, you know it's a green color. When you see a red color, you know it's a green color, a red color. A 5-year-old knows that. right? An adult knows that, a child knows that. So it becomes very easy to relate with what's happening in the market per time. When you see a green candlestick, what's happening there? You can easily know what happens there or what happened there. If you see a red candlestick, you can easily know what happened there, right? So that's why it's very important and visually appealing. Now, this is a candlestick. This is like the breakdown of a candlestick right here. So most of the time, we use the colors green and red. Sometimes it could be blue and red, but the most popular is green and red. And now, why green? Because green just tends to represent, in our natural world, green tends to represent, nurture, something that is natural, something that is profitable, something that is refreshing, right? So usually we look at green, we take green for that. Now, these colors don't have to be green and red. Sometimes you find them as black and white, right? Sometimes they can be blue and something else. I'm just saying that the reason why you see more of green and red is because of what they tend to represent in our minds. Green most of the time represents vegetation, growth, growth, vegetation. That's the idea behind green. Then for red, anywhere you see red, of course, it's like blood on the streets. Blood on the streets, something bleeding. If you're bleeding, that represents blood, right? So that has to be something connected to price dropping, right? So that's where the idea came from. So you, of course, if for those who may not like the colors, they can definitely change it. But the most important thing is you understand what these colors represent and why they are widely used like this. So now let's pick these candlesticks. This is their typical. This is how they typically appear, right? Now let's pick the first one as green. You notice that the green has open and then it has close. And then what you see here is that price opened below and then it closed above. Price opened somewhere below and then it closed somewhere above. What this is telling us is that price appreciated in that period of time. Price appreciated in that period of time. And when we say period of time, remember I mentioned time frame before. Time frames right now on our charts, the charts we use for trading right now, we have time frames ranging from 1 minute all the way to 1 month, right? So you can actually look at the market from different time frames. You can decide you want to look at the market from the 1 hour time frame, in which case every candlestick you see is formed or was formed in the space of 1 hour. So this open close you are seeing here would have happened in 1 hour if you're on the 1 hour chart. If you're on the 4-hour chart, this open close would have happened within the space of 4 hours. If you're on the 15-minute chart, this open close would have happened in the space of 15 minutes. So you decide what kind of chart you want to use. You decide what kind of chart you want to use, right? When you are using candlesticks for market analysis, right? Now, for the green candlestick, you notice price moved from a lower point to a higher point. Price rose from a lower point to a higher point. So automatically that generates a green candlestick. Automatically that generates a green candlestick, right? Now look at the other one, that's the red one. The red one, for a red candlestick, you notice something. Price open high, and then close low. Price open high and close low, meaning that price dropped, depreciated, decreased in that period of time. Always remember, candlesticks are spoken of in a period of time because there are different periods, there are different time frames. So you always need to speak with respect to a time frame or a period. Okay, so that's why I'm saying price depreciated or appreciated in a period of time. It does not mean that this thing happened for a whole day or it happened for a whole week. This is just a time frame. This could have been 15 minutes. This could have been 1 hour. So you always need to think when you see a candlestick, either red, green, red or green, you always need to ask yourself, what time frame am I on? Because with the time frame you are on will determine what you're seeing. If you're on a higher time frame, a time frame like the monthly chart, the daily chart, the weekly chart, or even the 4-hour chart, what you are seeing may give you a certain picture, right? In terms of the color of the candles, right? If you are seeing a green candlestick or a red candlestick, there's a certain picture that will give you if you're on a higher time frame. But if you're on a lower time frame, like the 1 minute time frame, you will also see green and red candlesticks. But the picture it gives you might be different. So that's the reason why many times you always have to ask yourself, what time frame am I on? That's very important in terms of seeing, in terms of having clarity of how the market is moving overall, right? So you see price depreciated from top to bottom in that automatically forms a red candlestick. That automatically what forms a red candlestick. Okay. So let's look at this. Now this is like the breakdown of a candlestick itself and the anatomy of a candlestick. So you notice that whenever you go to your chart, open your MetaTrader 5 now, to the bottom of the screen, you see quotes, you see charts, you see trade, you see history. Now, under charts, you open your chart, you automatically see candlestick, red, green. Now, you will notice that a candlestick, a green candlestick would typically look like this. Not all the time, but most of the time, it would typically look like this, right? Now, there is something like a pin at the top and at the bottom. The length of those pins can be very long. It can be very much or it can be very small. It doesn't really matter. What matters is that there's a pin at the top and at the bottom. Those pins are what we call shadows. Just the way human beings have shadows, candlesticks also have shadows. Okay. Now, so those are what we call the candlestick. The pin at the top is what we call the upper shadow. The pin at the bottom is what we call the lower shadow. Now, these shadows are very important when it comes to understanding how candlesticks work. Very, very important. The type of pin that formed, the way the pin is formed, the length of the pin tells you so much about what a candlestick is likely to do going forward, right? So that's why we pay attention to that a lot, right? But for the purpose of this, just understand that there's usually a pin at the top and the bottom, and you can look at your chart. So you're doing this, as you're going through this class, you can just open your MetaTrader 5, go to chart, and you'll see what I'm saying right now, right? You see there's an upper shadow and a lower shadow. And then there is the green part. That green part is what we call the real body. The real body, right? So, and here, notice what we said earlier. We said that a candlestick is represented in a certain way, and it usually has open, high, low, and close. Open, high, low, close, right? So you can see how is represented here. Now you see you have an open, this for a green candlestick. You have open, you have a close, you have a high, you have a low, right? So I'll show us the order of that zone, but this is just like a general overview of what a candlestick would look like, right? A green candlestick looks like. Now let's look at a red candlestick here. So you notice it's basically the same thing. You have a pin at the top, you have an upper shadow, you have a lower shadow for a red candlestick. Then now you notice something, then you have a real body too. The real body is the red part. You notice that the open and close especially are flipped in this case. In the case of a red candlestick, the open and close are flipped. And that's what we said earlier. We said for a green candlestick, price moved from a low point to a high point in a time frame, in a period of time, let's say 1 hour, right? Now for a red candlestick, price moved from a high open, right, a high place to a low place, which means that is a decrease, a depreciation in price in that period of time. So that's where the flip comes from now, right? So let's look at this. Now, a green candlestick is what we call a bullish candlestick. A bullish candlestick, bullish generally means rising prices. Whenever prices are rising, we refer to that as a bullish environment, a bullish scenario. So anytime you hear bullish or bull, that means prices are going up, prices are rising, prices are appreciating. Okay, so you see a green candlestick, that is a bullish candlestick. Okay, Now, it doesn't mean the entire market is bullish when you see a bullish candlestick. No, it just means that that candlestick is bullish. Okay? Of course, you can find bullish candlesticks within a downtrend. So trend is a totally different thing. This one now doesn't mean buy or sell. What we are doing here, guys, is basically understanding the candlestick itself. Now, eventually, after we understand this, we are going to begin to put it together to use it for analysis. But that's not the purpose here yet. The purpose here is for us, first of all, understand this. Most of the time, people ask me, okay, does it mean when you see a green candlestick, you should be buying? No, it doesn't mean you should be buying. It just means that you are understanding what we're doing here is understand the candlestick first before eventually you start to use it. Okay. So you have an upper shadow, you have an lower shadow, just like I said before. Then that's for a bullish candlestick. Then for a red candlestick is what we call bearish candlestick. Bearish means that prices are dropping, prices are depreciating. That's where the idea of a bear comes in, right? So we have bullish and bearish. Now this is what it is here. So you see, you have bullish, you have a bullish candlestick, you have a bearish candlestick. So now talked earlier about the open, high, low, and close. So how does that work? How does that work? So let's look at this now. Now, this candlestick opened low and closed high, so automatically became a red candlestick, right? So now, but let's look at something here. So price opened at 100. These are just numbers to help you understand what we are talking about here. So you see that price opened at 100. It dropped first to a low. So price will open, then come to a low, typically most of the time. Come to a low, right? And then from a low, it starts to rise, gets to a high, and then eventually close. Okay? And then eventually close. So you see that price opened at 100, dropped to 80. Then from 80, it picked up. 80 became the low. Now, there is no way, if you're looking at this on a not regular chart, you will not know that 80 is the low until the market has showed you that 80 is the low. So you see that price dropped to 80 and then eventually it started reversing from there. So it reversed from this low, started pushing up, pushing up, pushing up, and then got to the high, rose to a high level of 200, then eventually dropped and closed at 80, at 180. And once it closed, what happened? Another candlestick opened immediately within nanoseconds. Another candlestick opened, right? Now let's look at the bearish one. Bearish candlestick. Now for the bearish candlestick, price opened at 200 here. That's a high point. Then it went up to a high of 220 first. So you see we have open. Now we have a high. From that high, price started dropping, dropped all the way to the low of 100, and then pushed up and eventually closed at 120. So this is more like the journey of price. So the shadows of a candlestick are more like footprints of price. So when you look at a candlestick, look at it and you're thinking, okay, this candlestick closed bullish or it closed bearish. But that's not the entire story of that candlestick within that time frame. So the shadow tells you the story, the entire journey of that candlestick in that time frame. So it means that it's more like when you walk into a place, when you come into a place and there's someone had walked past that place with, like mud feet, right? You will see that someone passed through this place. You will see that someone passed through this place, but you may not see the person. The person might have passed, and you will know whether the person is an adult, is a child, or is not. Or even if it's not a human being, you will know that someone passed here because of the type of feet that you're seeing, right? So that may give you a certain idea of what's happening there, what happened there before you came there. That's exactly what shadows are for candlestick. So if you look at the candlestick, the way the shadow formed tells you where price had been, what happened with price before eventually it closed the way you're seeing it now. So shadows are not something you discount and just say, okay, it doesn't matter. It matters a lot, right? It tells you what happened, what price did in the previous candlestick before eventually it closed, right? Okay. So let's move on now. Let's move on here. So we're going to be looking at a few of the candlestick patterns, that we have. And we've just looked at this. Price has open, high, low, close for a bullish candlestick. And we have open, high, low, close for a bearish candlestick as well. So now we know we have bullish candlestick, we have bearish candlestick. That's what we just talked about. Now, when it comes to patterns, candlestick patterns tell us a lot, about what price is likely to do next. Like I said, the first thing is understand the candlestick. So when you see a green candlestick, you know what happened there. When you see a red candlestick, you know what happened there, right? Now, when it comes to patterns, you are not just looking at one candlestick. Most of the time, you're not looking at a single candlestick. You're looking at a set of candlesticks. It could be two or three, usually two or three, to give you an idea of what price is likely to do next. So the way one candlestick forms cannot tell you what price is going to do next to a large extent. In some cases it does, but in most cases, one candlestick cannot tell you what price is going to do next. Because guys, what we're always thinking of as traders is what is price going to do next? What is price going to do next? Because our trades, our profit, the monies we want to make in the market is always in the future. And the reason why we're looking at candlesticks that are formed already is because it gives us historical data about markets. So we are looking at the market and we're thinking, now, what am I going to do next based on what has happened before? So now you have to go first and understand what has happened before to help you determine what is likely to happen next. Because in the market, history repeats itself a lot, right? The market's always going around in circles, always going in circles. So what has happened before is likely going to happen again. Chances of it happening again is very, very high. In many cases, it will happen the same way, the exact same way it happened before. Sometimes there may be a bit of variation, but in many cases, it will happen exactly the way it happened before. But even if it doesn't happen the way it happened before, you will see that the patterns are close. So what we're going to be looking at here is candle patterns, not just one candlestick, but candlestick patterns. So a situation where you can put two candlesticks or three candlesticks together and it starts to make sense as to what the market is about to do next, as to what the market is about to do going forward. All right. So here, let's look at this. We have these two candlesticks here. We call this formation a bearish engulfing. Okay? Now, it's very simple. This is very simple. You have a green candlestick followed by a red candlestick. So you have a bullish candlestick followed by a bearish candlestick. Now, one thing you have to understand is that every time in this market, at every moment in time, you will see a candlestick forming. There is bearish volume and bullish volume within one candlestick. There's bearish volume and there's bullish volume within the candlestick, right? Now, the way a candlestick closes now tells you who overpowered who. Okay? The way a candlestick closed now tells you who eventually won the battle, the tug of war between the buyers and the sellers. So if you see that a candlestick eventually closed, remember, you cannot determine what a candlestick will do except it closes. So when a candlestick closes, let's say in red, that tells you that, oh, the sellers eventually overshadow the buyers. That's why it closed in red. The sellers eventually overshadowed the buyers, then it closed in red, right? Now, if it closed in green, that tells you that, oh, the buyers eventually, if it closed in red, the sellers overpower the buyers. If it closed in green, it means the buyers overshadowed the sellers. So why I mentioned that now is that the way a candlestick forms, or now we're looking at patterns here. The way the candlestick pattern is or forms tells you a lot about what's going on in the market, and consequently what is likely to happen next. But the way a candlestick pattern forms tells you what is happening in the market currently and what is likely to happen next. All right. Now let's look at this. So you have a bearish engulfing. What is bearish engulfing? You have a green candlestick followed by a red candlestick. And this red candlestick engulfs the green candlestick, which means that it covers it, is way bigger than the green candlestick. You see? Now, when you see that, the size of the candlestick also tells you something. It's like when you fill up a glass, let's say a bottle, let's say a big bottle, you fill it up as against you just putting some little water inside. You want to put water, you put a little water and it's just under it there, underneath. Or you fill it up. When you fill it up, it tells something. So it means that there's a lot of flow. That's why that bottle can fill up. If the flow is so small, if the water is so small, that means that the flow is very small. That is what this is also. We can take a cue from that when understanding this. When you see a huge red candle, it tells you that sellers are very much in the market, or it may not be sellers in terms of numbers. It may be sell volume. One person can push a lot of volume into the market and is very heavy, right? Because one person comes in with a lot of money into the market and he overpowers 100, 1,000 people because he has more money. So we are mostly talking about buy or sell volume rather than buy or sell, rather than buyers or sellers. Because you could have 1,000 buyers, but there's one seller that has more money than the 1,000 buyers, right? And then he will crush all of them where he places his sell. So in this case, you will see that what happened here now is that while we had a bullish volume here to start with, but the sellers have now taken over the market. That's why the candlestick is so large and caused an engulfing. The sellers have taken over the market. So what will happen with this is that something will happen next. Likely, there are going to be market might eventually sell. Now we have second part of this class, we're going to be really breaking that part down, right? I'll show you more examples with that. But this is just for us to help understand these patterns first, right? Now, look at this. This one is what we call, this what happened here. That's where the bullish and bearish engulfing came from. Now, look at this. You have this what we call the bearish tweezer. Tweezer is basically two candlesticks that look alike, but they are opposite. They look alike, but they are opposite in color. So you see that price moved up here, opened up and closed, and then opened and opened for a sell, went up and then eventually closed down. When you see a bearish tweezer like this, a green candle, a green candlestick followed by a red candlestick is signaling a sell. It's signaling a sell. Just think about it as a red following a green. When a red follows a green, that's a sell signal. Now, this is the opposite of bearish tweezer. This is a bullish tweezer. Okay, so when you see a bullish tweezer like this, now sometimes this tweezer you'll see here, this candlestick have wicks, right? It has shadows. We talked about shadows just now. These two candlesticks have shadows. Sometimes these candlesticks would not even have shadow at all. Would not have a shadow at all, right? So in that case, you will see that these two candlesticks will be full body. They will be full body like this. Full body green, full body red. It's the same thing, right? So these ones have shadows, but sometimes tweezers may not even have shadow, but then they are still very valid. Then when you look at this, is what we call a bullish tweezer, right? So you see a red candlestick followed by a green candlestick of the same height, size, and everything. They are usually of the same size and height. but they are two different colors. One is green, one is red. So in this case, this is a bullish signal. It means that price is about to buy. So it follows, price will follow the direction of the most recent candlestick in the terms of a tweezer, right? So if you look at a bullish tweezer, a bearish tweezer, the most recent candlestick is a red candlestick, which is a bearish candlestick. So price is likely to go in that direction. If you look at a bullish signal, a bullish tweezer here, the most recent candlestick is a green one, and price is likely to go in that direction. Okay? Then we have a bullish engulfing here. We have a bullish engulfing. So a bullish engulfing is the opposite of what we talked about in bearish engulfing. And what it means is that you can see how the strong bullish candlestick went up after a small red candlestick formed. The bullish candlestick was just so strong. What it tells you is that buyers are taking over the market. As much as the first candle was red, but buyers have now taken over the market. That is the purpose of a bullish candlestick or a bullish engulfing like this. Buyers have taken over. So when buyers take over, what's price likely to do? Likely to go up. So this pattern, these candlestick patterns we call reversal patterns, they give you an idea of what price is likely to do going forward, rather than just a single candlestick. Single candlestick, you can look at a single candlestick and say, okay, this is bullish or this is bearish, but it doesn't tell you where the market will do next. But when you start to see a pattern like this, then you know that the market, this is going to give you an idea of where market goes next. So the next one is what we call dojis. These dojis are what we call indecision candles. But even though they are indecision candlesticks, the way they form can tell us whether can tell us what they are about and what decisions they can help us make. Right? Now let's look at this. You can see there are 4 candlesticks here right now. And 4 candlesticks right now. This one is indecision. When you look at it, it means that price close and open. One thing with dojis generally is that price close and open where it's price open and close at the same position. So price opened at this point and closed at the same point. That's why it's showing you like a black color instead of a green or a red, right? Even on your system, it will show you a black color when you see a doji because price closed at the exact same location, at the exact same spot that it opened. That's where it also closed. So look at this. You see that price open and close in the same point, but this one is telling you something. We'll discuss it in a different session. When you look at this, price pushed up. Though it opened and closed in the same position, it created a shadow at the bottom. That's something. Now look at the third one here. Price opened and closed at the same spot, but it created a shadow at the top. That is something. And the fourth one here, you can see this one, price went up and down and closed in the middle. That is proper indecision. Because at that moment, you don't know what price is going to do. Is it going to buy? Is it going to sell? You don't really know because price went up, came down, and closed in the middle. So in that case, buyers and sellers, no one is winning. Between buyers and sellers, no one is winning, right? Now, this is what we call the evening star. It's what we call the evening star, right? Now, for the evening star here, you see that price rose point, and then it formed this set of candles, these 3 set of candles like this. When you see this, it's telling you something. It's telling you that price is about to sell. Now, there's a little bit of context too that we will add to this in a different session, in the next session of candlestick. But these are just patterns. You can, first of all, focus on recognizing these patterns. Focus on this pattern recognition. When you get this pattern recognition right, then it will now be perfecting how to use them. Perfecting how to use them in the market. Okay. So yeah, so this is what we call the evening star. Then you have a hammer. Hammer is a candlestick that has a long wick at the bottom. Long wick at the bottom. Okay. And typically it looks like a hammer. then it's either that body at the top here is usually either green or red. But when it is green, it is considered more bullish, which is much better than the red one. The green one, the one that closes green, is much better, is much more bullish than the one that closes red. Right? Now, this is the inverted hammer. This inverted hammer is and is also known as shooting star. Inverted hammer and shooting star are exactly alike, right? Now, look at this. So you see that it's more like a hammer, but in the opposite direction. More like a hammer, or in the opposite direction. In this case, this one is indicating that price is likely going to sell. But then the one that is bearish, red, is much more, the one that is red is considered more bearish than the one that is green. So we prefer, if we were picking this signal to trade with, we prefer that this candlestick is red rather than green. Same thing happened here as well on that shooting star. We prefer the candlestick is red rather than green because it's meant to give us a sell signal. So if it's giving us a sell signal, we want to see red candlesticks for us to be more confident when getting into sell opportunities, right? Then we have morning star. Morning star is the opposite of evening star. It's the opposite of evening star because for morning star we are looking at a bullish signal. It's a bullish signal. Price has been selling. Price is about to resume its uptrend. Price is about to resume an uptrend. So this is a buy signal. Morning star is a buy signal. So like I said, guys, the most important thing here for now is make sure you're focusing on pattern recognition. Recognizing these patterns. Using them is what we're going to talk about in the next class. But for now, we want to focus on recognizing them so that we can always spot them. These are so easy to spot. If you train your eyes to see them, you can easily see them like that, sharp. And see them quickly. You can just scan your chart like this and see them, spot them in different places, right? Then you have spinning tops. Spinning tops, these are two different candlesticks as well. They look exactly like this. They are almost like indecision dojis, but they are not indecision dojis. They have a small body in between. They have small middle body, right? One is green, one is red, small middle body. Okay? That's another pattern to watch. Then you have three black crowns. These three black crowns are a bearish signal. When you start to see that forming, it tells you price is about to get into a downtrend. Okay? Now you can see that all the time. It's always on the chart. Every time the market is about to sell, most of the time the market is about to sell, you're likely going to see three black crowns. And that's a signal to you, telling you that, oh, price is very likely about to sell now with this pattern. Okay? Then you have the three inside down. You have a green candlestick, price has been bullish. You have a green candlestick, you have a red followed by a red. Now, with these two red forming, you will see that you are expecting price to drop further. That's what we call the inside crown. Now, names are good, you remember them, but the most important thing to remember is the pattern. If you remember the pattern, then you can always spot it irrespective of the name. Even if you forget the name and you keep the pattern, you understand, you're able to spot the patterns. This is to make money. It's not for, not mainly academic purposes. For academic purposes, it's mainly for profit purposes. Okay, we're going to focus on profits rather than just learning for the purpose of learning. So you have as for three inside crown, three inside down. This is three inside up, opposite. Three inside down, three inside up. Three inside up is for buy. We're expecting price to continue to be bullish, right? Then you have three white soldiers, just the way you have three black crowns here, which is bearish. You have three white soldiers, which is bullish. Okay? Oh yeah, these are the patterns. These are the most important patterns. In fact, you may not need to use all these patterns. There are some that are more popular than others that you can just stick with. It depends on what you're trading. If you're trading so many different instruments, so many of trading a whole lot, you might need most of them. But if you're trained, if you have just a few instruments you're focusing on, which profitable traders do, you may not need so much of them, right? But of course, at one time or the other, you will be able to spot these patterns and you'll be able to take advantage of them to make them. So, do we have a question? We're going to end our class here today. We have a second part of this class, like I said, and we're going to be delving more into using these patterns. But first of all, focus on pattern recognition. Do we have a question? Who has a question?